Hello, so today I'm going to be going through part 2 to the changes in partnership. Okay, so in the previous video, part 1, we had a look at the admission of a new partner. So simply what happens when a new partner joins. In summary, they will bring capital to the business, and some of that capital is given to the existing partners as a payment of joining an established business, and that's what we call goodwill. Okay, so you can refer to part 1 if you want to have a look at goodwill. And simply, if a business decides to take on a new partner where that business is established, they've done particularly well, they're successful, they can charge goodwill to the new partner. Okay, and the way that charge takes place is through capital reduction. So whatever money they bring into the business, that capital is reduced, and the reason why it is reduced is because some of that cash is given to existing partners. Again, we looked at that in part 1. So part 2, what we're going to look at is the retirement of a partner. What happens when a partner decides to leave the business? Okay, so what happens is, let's just say there is a partnership of 3 people and one person decides to leave. The partners that end up remaining, what they will do is they will pay off the person who is leaving. So 3 partners, partner A, partner B, partner C. C decides to leave. A and B will pay C off. Okay, so C is basically leaving with his share of goodwill. Okay, obviously if C decides to leave, he's going to say to the other 2, I'm leaving now, can I have my share of goodwill? I've worked in the business, I've worked hard, I've put lots of time in to supporting the business, can I have my share of goodwill? And the only way the business is going to pay him off is through A and B. The other partners will pay C. Okay, so existing partners, what will happen is they will reduce their capital to release a share to the retiring partner. Just how in part 1 we looked at the admission of a partner, someone joins, their capital is reduced, and for a retirement situation, the retiring partner will leave with extra capital, and the reason why they have extra capital is because A and B will pay them off. Okay, so a retiring partner will leave with their share of goodwill, and so what happens to the other 2 partners? Okay, is it fair to say that their capital has gone down? Well, yes, it looks like it isn't fair, but what happens to A and B is when they sell the business on, then they will get their fair share. Okay, so when the 2 remaining partners sell, they will then benefit from the sale of goodwill. Okay, so really, partner leaves, they get their share. The other 2, in the short term, will have to bear with it. However, when they sell the business, that is when they will receive their share of goodwill. Okay, let's have a look at an example. Okay, so we have 3 partners, Gareth, James, and Stephanie. I'm just going to switch tabs. I've done a bit of a format for you. Okay, so we have 3 partners, Gareth, James, and Stephanie, GJS up there. They all hold 45,000 as their capital balances. I'll put that in a moment, and they all hold equal shares in the company. Gareth is retiring. Okay, so we have Gareth, James, and Stephanie. They all have an equal share, 1-to-1-to-1, or 33% each, however you want to do that. That is before. After, Gareth is leaving, so I've put across there, James and Stephanie are going to continue with equal partnership. So Gareth is going to retire. Remaining partners will share profits and losses. Goodwill is valued at 15, and we need to do the capital accounts for each of them. as well as the goodwill account. Okay, so it is the same as part 1. We create goodwill on the old ratio and we eliminate goodwill on the new ratio. So let's get started, and if you want to have a go, feel free to pause and have a go yourself now. Okay, so let's get started with this question. So 15,000 divided by 3 equals share. So 15 divided by 3, so we've got 5,000 split 1, 2, 3. I'm just going to copy that, make things easy for myself. Actually, what I'm going to do is just type it up. Not keen on the line being copied up from above. Okay, so we have 15 divided by 3, the old ratio. So we have S cap, J cap, and G cap. Okay, they're capital accounts. So these are my debit entries, and I'm going to do the credit entries up here. So we've got 5, 5, and 5. Okay, and that has come from goodwill. Could have just copied it before, but there we go. Okay, so I have just done the debit entries and the credit entries there, and that adds up to 15. Okay, so that is the creation of goodwill. Let us eliminate. So 15 divided by 2, and the reason why we're doing 2 is because Gareth is leaving. Okay, so we divide 15 at the new ratio, old and new. Okay, 7.5 split 7.5 and 7.5, and that is going to go to J and S. So I'm just going to copy that detail from there. Okay, so 15 divided by 2, we are splitting it between J and S, not Gareth, okay, because he is going to leave. Okay, so 7.5, let's do the double entry. So we have a credit entry here, which means a debit entry there, and a debit entry there. And our detail is goodwill, and I'm going to copy that over here as well. Okay, so credit, debit, credit, debit. Gareth isn't going to get an entry because he isn't there. Okay, that adds up to 15, so my account balance is, and let's balance off the other accounts. Okay, so we have 7.5. Oh, actually, I've missed something out actually, and that is the opening balances, the 45 opening balances. I'm going to just squeeze those in first. So they've all got 45. I should have done this before, but I haven't. Let me just squeeze that in above. You can do it underneath, it doesn't really make any difference. So I'm just going to copy that. Okay, so let me just do a quick recap. So we've got 45 opening balance, 45 opening balance, 45 opening balance there. We have goodwill 1, 2, 3. These 3 are credit entries, and they have come from here. Okay, and then we have the 2 debit entries, 1 there, 1 there. Okay, so yeah, preferably do the opening balances first. Anyway, let's get to balancing off these accounts. So we've got opening balance, goodwill, totaling up 50. Let's take it across, and difference above 42,500. Okay, now what I've just done here, that is my balance carried down, and I have a balance brought forward 42.5. Okay, now you can see these two, they are exactly the same. So all I'm going to do, I'm just going to copy this over there. No point typing it all up again. As for Gareth, that totals up to 50, and I'm going to take it across, and there's a difference above of 50k here. Okay, what I'm going to do is I'm going to type bank here, and I'll explain what's going on. Okay, so if we have a look at Stephanie, she started with 45. She has now ended up with 42.5. So her capital has come down, and the reason why it's come down is because it's come down by 2,500, and that 2,500 is going to Gareth. Stephanie's continuing in the business. Gareth is leaving, so the existing partners have to pay him off. He's leaving, he wants his cash, he wants his share of goodwill, and he wants 5,000. Again, that's calculated through what we've done here. Okay, 15,000 goodwill, equal share, he should get 5k, and he's got his 5k there. Okay, and the reason why how has he got £5,000? 2.5 from Stephanie, 2.5 from James. Okay, so you can clearly see Stephanie's capital has dropped 2.5, 45 to 42.5. That is a 2.5 decrease. It is exactly the same for James, 45 to 42. So he's given up 2.5. She has given up 2.5. He has benefited. Okay, he started off with 45. How much has he got left over at the end of it? He takes home 50k. Okay, now when a partner retires, obviously some of you might have been expecting that I write balance carried down. I'm not writing balance carried down because he is leaving. There is nothing to carry forward. He is going to take his cash with him, and he's going to leave the partnership. Okay, there is nothing that tells us in here other than that, so we are assuming he is taking his money with him and he's leaving the partnership. So you add the two together, you take it across, the difference above, and the difference is going to be bank. And normally with an AQA question, they will say to you, he will be taking the value of the remainder of his capital in the form of cash. Okay, or the business or the partnership is to pay him through a check or something of that kind of nature. Okay, which tells you bank. Okay, so that is one question on the retirement of a partnership. So in summary, existing partners' capital will reduce and the one that is retiring will increase. Okay, let's have a look at another question. Okay, so we have a tick box question here. Let me just quickly have a look and see what I've done, if I've done the full T accounts or not. Okay, I think I have done. Okay, so feel free, if you're confident now, feel free to pause the video, have a read of the information and draw up capital accounts for all of them, as well as a goodwill account. Okay, so do the full question and then it'll be nice and easy for you, a bit of practice for you. Okay, so what I'm going to do is I'm just going to fill in that gap there. And let's have a go at this question. So we have three partners, Mia, Neil and Ollie. Okay, sharing profits equally on a 1:1:1 split ratio, or 33.3%. Mia is going to retire, so we're going to put a cross there. Mia is going to retire. And it is agreed that goodwill is worth 30. After Mia's retirement, Neil and Ollie will continue to run the partnership equally. Okay, so Mia is going to retire. Let us do the double entry. So goodwill, 30k, divided by 1, 2, 3, 10k split. Oops. My number 1 doesn't seem to be working. Okay, so this is going to go to M cap, N capital account, and O's capital account. So that is the creation of goodwill on the old ratio. Let's do the double entry for this. So they are all going to, we've got debit entries here, we're going to have a credit entry there, and that's come from goodwill. Okay, so I have debit entries here, so credit 1, credit 2, credit 3. I'm just going to copy this over because it's the same thing for all 3 partners. Okay, so in summary, we have debits, credit 1, credit 2, credit 3. Now we are going to eliminate goodwill, so 30 at the new ratio, old and new. However, this time we're going to split it between 2 partners, so 30 divided by 2, so 15. Okay, now this is going to N and O only. We are not allocating this to Mia because she is leaving. So N and O should be the detail, and I've just copied that over there for ease. Okay, we have credit entries here. Let us do the debit entries. So N and O. Credit, debit 1, debit 2. And my detail is goodwill. Okay, so N and O are both going to have the same entry in their accounts. You'll notice from this question compared to before, we haven't been given any capital balances, okay, but I will talk you through exactly what is going on in the question. Okay, so if we have a look at the existing partners, the ones that are going to remain, have a look at the account. Capital, an increase is on the credit side, a decrease is on the debit side. So overall, you have a decrease because that's going down and that is going up. So overall, N's capital account is falling by 5. O's capital is also falling by 5. That is a decrease. Okay, so existing partners will fall in value, whereas the person who is retiring will increase. So that's why Mia has got a positive on capital. Capital has increased by 10. So N has given up 5. 10 increase, 5 decrease. Sorry, 10 increase, 15 decrease. So overall it is a 5 decrease. Overall a 5 decrease. So 5 from N, 5 from O, given to Mia. So Mia will leave with £10,000 for her effort and part in the business. Okay, as for the question itself, what will be the goodwill adjustments to Neil's capital? Well, 15 debit, 10 credit. 15 debit, 10 credit. So the answer is D. Okay, the answer is D. Okay, so I think we've got 2 questions only for retirement. Okay, the next part, which I was going to do in another video, but seeing as it's not, it's only been 18 minutes so far, I'll squeeze it into this one. The next part 2, changes in partnership. So part 1, the first part is admission, the second is retirement, the third is any changes in the profit sharing ratio. Okay, so what does this actually cover? So we've got an example here. Let's just say there is a partnership of 2 individuals and things so far are 50-50, however they decide to change them to 60-40. Okay, what about if one partner has more investment than another? Okay, things are changing in a partnership, so investment levels. Or perhaps one partner is more committed than another, or decides to take on more work than another. Okay, admission and retirement we've already covered, so these are part of the changes in partnership. But regardless of whether it's investment levels change, levels of commitment change, or there is a new partner or a partner retires, all of these different options will change the profit sharing ratio. Okay, and that's when we need goodwill to adjust the accounts. Now, generally speaking, what happens is if a partner wants more of a share in the business, okay, so they want a higher level of equity, they want more share, they will have to give up some of their capital in exchange for more share, okay, and what will happen is they will have to pay off. So if there were two partners in this situation, 50-50, 60-40, the one who's taken 60% share will have to pay the other partner a share of goodwill. Okay, they have to pay them a share of goodwill. Take more share in the business, pay the other partner through a capital reduction. Okay, let's have a look at a question. This kind of topic is best understood through examples. Okay, so let's have a look at a question. So we have Bart and Lisa. Let me just scroll down, and I have a template here for us to work on. Okay, feel free, even though you might be thinking, okay, I'm not exactly sure what's happening in this, feel free to pause the video and have a go at it. All you have to do is follow the process of goodwill. So you create goodwill on the old, and you eliminate goodwill on the new. That's all we are learning about, okay? So feel free to pause the video now and have a go at this question. Otherwise, let's have a look. So we have Bart and Lisa equal partnership, 50-50 before. Capital balances are 35 and 45. This doesn't necessarily matter. It is just some figures that I've made up. Okay, so we can just put these into the accounts. Doesn't make any difference to this particular question. Okay, the partners agree from the next period, Bart is going to have more and Lisa is going to have less. Goodwill is 40. Okay, so let us create goodwill and eliminate it. So 40 split 50-50 on the old ratio, so we have 20,000. Okay, and Bart's capital and Lisa's capital. Okay, before I do the double entry for this, I'm just going to put in the opening balances. So Bart has 35. And Lisa has a bit more. She has 45. Okay, so we've got opening balances in there. We've done the debits. Let us do the credits. So we've got debit here, credit over there. And that is from goodwill. And I'm just going to copy that over because it is exactly the same for Lisa. Okay, the only difference here is the opening balance. So we've got goodwill, debit, credit there, credit over there. Okay, so we have just created goodwill. Now we need to eliminate. So 40, instead of doing 50-50 split, we are now going to do 40 through a 60-40 split. 6 times 4 is 24, so we've got 24,000, and the difference is 16. Remember, it's got to add up. Okay, they've both got a total 40. Okay, 24 is for Bart, and the other one is for Lisa. Okay, you'll see when we've reviewed this particular scenario, it should all make sense to you. Okay, in terms of why are, what's the 24-16, what's going on here? You'll notice through double entry, and when I do a quick recap, exactly what's going on. Okay, so we have 24 credit, 24 debit, 16 credit, 16 debit, goodwill. Okay, so let's balance off the account. So I'm just going to add these up. So 35 and 20 is 55. Take it across. Difference above. 55 minus 24 is 31. That is my carried down, and my brought down is over there. Okay, Lisa, 65, take it across, and difference above, which is 49. And my balance brought forward 49. Okay, so let's have a look. So Bart started with 35 and he has now ended up with 31. His capital has gone down. Reason for that is because he has taken more of a share in the business. So his capital has gone down by how much? 4,000, which means that 4,000 is going to go to Lisa. And we can check it. 45 she started with, she's now left with 49. Her capital has gone up by 4,000. So in essence, what's happened is Lisa has given up 10% in exchange for £4,000. Okay, so Bart has agreed to that. Bart has let go of 4,000 and he's taken on 10%. Lisa has lost 10%, but she has gained 4,000 in capital. Okay, and that's the nature of business, right? That is the nature of business. If you're going to give up a share of a part in your company, then you are effectively selling up your part and you get extra capital. Okay, so that is a question on the profit sharing ratio, and I hope that makes sense. Okay, let's see what we have left. Now what I'm going to do is I'm just going to zoom in because I think that might be a bit too small for you. Okay, so I must have done a format for this. So what I'm going to talk you through, this is another question to do with the profit, a change to a profit sharing ratio. We have Dave and Elsa, who are the partners to this particular business. What I'm going to do is have a quick read of the scenario, and then I'll give you a heads up if you wanted to pause, and then I'll talk you through the scenario myself. So, two partners, Dave has 80, Elsa has 50. They agree, actually, I need to look at the top. So am I missing something? Oh yes I am, I was wondering that. So Dave and Elsa, they are in partnership sharing profits equally. So before, 50-50. Okay. The partners agree that from the 1st of October, Dave is going to take 2/3 and Elsa taking 1/3. So Dave is going to take 2/3, 66, and Elsa is going to take 1/3. Goodwill has been valued at 45. And we need to create and eliminate goodwill. Now, I'm not going to do it in the journal. I'm just going to do it in the T account format, which is absolutely fine. Okay. So what we need to do is do the double entry for goodwill, do the double entry in the capital accounts, and change this according to the new capital account. So it is quite straightforward. Number 1, goodwill. Number 2, capital, double entry, what I've been talking you through so far. And number 3, redraft these figures because the capital accounts are going to change. So let us create goodwill. So 45 on the old ratio, split 22.5. Okay, and that is going to D, and that is going to E. 45 on the old ratio. These are my debit entries. And before I do the double entry, I need to quickly put in the opening balances. Dave has 80. And Elsa has got 50. Okay, so opening balances are in there. These are my debits. Let us put the credit entries in there. 500. Goodwill. They're both the same. I'm just going to copy them over and put them into the other account. Okay. Let us eliminate goodwill. So we've got 45, 66, 33, i.e. 2/3 and 1/3. So 45 divided by 3 is 15. So we've got 30 and 15 split. Okay, so I've got 30 and 30 is going to Dave. So D cap and E capital. Let us do the double entry. So credit entries here. Let us do the debit entries. And goodwill is my detail. I'm going to do the same for Elsa. Not 5. Okay, so these add up to 45. Always make sure the goodwill adds up and balances off. So Dave started with 80, 22.5 and 30. Elsa started with 50. We've got 22.5 debit, 22.5 credit, 15 credit, 15 debit. Let's get these balanced off and then we can see exactly what is going on with these accounts. Okay, difference above 80 plus 22, 102. Take it across, difference above 72.5. That is my balance carried down, and my balance brought down 72.5. Let's do the same for Elsa. 72,500, 72,500, and the difference above is 67.5. That is my balance carried down, and my balance brought down is 67,500. Okay, let me just check those figures. Have I done that right? I don't think I have done that right, have I? $50, $60, $70. Okay, that's better. Okay, so yeah, that's better. Okay, so Dave started with 80. He's now ended up with 72.5. He has reduced his capital by 7.5, which means Elsa should go up by 7.5, and she started with 50. She has now ended up with 57.5. Her capital has gone up by 7.5. So Dave has given up 7.5. Elsa has received an additional 7.5. Okay, and the reason for that is because Dave has taken 16%, an increase of 16%. Elsa has reduced her share by 16. Dave's taken on 16. Elsa's reduced 16. Dave has paid Elsa off through £7,500 for the additional share in the business. Okay, so task 3, what does the FP show? It's not going to show 80 and 50 anymore. It is going to show Dave with 72,500 and Elsa with 57,500, and if you add them together it equals 130,000. Okay, so the value of the company in terms of capital is not changing. Capital is just basically moving. Dave is going down, Elsa is going up. Still equals the net assets figure. Okay, so I'm just going to check the figures one more time to make sure it is all correct, and I'm happy with that. Okay, so that is another question on the profit sharing ratio, and it's quite straightforward. If you think about it, if a partner is going to join, they bring in capital. Their capital has gone down because they pay existing partners for joining. If there's a retirement, the one who's leaving is going to take their share, How are they getting it? It's because the existing partners are paying them. And if there's a change in the profit sharing ratio, if you want more share in the business, you have to pay the other partner. So your capital goes down. Your capital goes down, but your share goes up. Okay, so the last scenario is if you want more share in the business, that is fine, but your capital has to go down because the other partner has to be paid for that. They can't just give up share in the business. Elsa can't give up, 16% in her business. She's going to want cash for it. Okay, it's the equivalent of selling shares in a business. If you own shares in a business and you sell them, well, you lose your share in a business and you get your money. Okay, you invest in Tesco's. If you sell your shares in Tesco, you give up your 1 or 2% in the business, but you get your cash. Okay, you get your cash, and that is how this works. Okay, so in summary, that is what we have looked at for over part 1 and part 2 changes in partnership. Hope you found it useful, and thank you for listening.